Hi guys, welcome back to my channel. My name is Noguhle Khumalo and you are tuned into the investing series. Over the next couple of weeks, I'm going to be teaching you guys about the basics of investing. In the past video, we covered what investing is and the risks that are associated with it. And in today's video, I'm going to be drilling down on stocks, shares / equities. So sit back, relax and enjoy this video. And before I forget, please remember that none of my videos constitute financial advice. This is meant to be a conversation from one friend to another. And like I always say, my aim is to plant the idea. It's up to you to water it. Let's get into it. So I know what's probably going on in your mind. You're probably saying she better be showing us how to buy these shares today, otherwise. But let me tell you something, in today's video we're not going to be getting into that. However, in the next video we are definitely going to be buying those shares. I'm actually going to be showing you guys live demonstration where we're actually going to go and buy 3 types of shares. So make sure you hit the subscribe button so that you don't miss that. However, because I'm a nice person, if you want this video earlier than next week, the only thing you need to do is make sure you hit the like button, and if we get to 800 likes before next week, I will drop this video earlier than expected. So the choice is yours. I'm gonna see what you guys can do, and the best way to do this is to recommend it to your friends, whether you're posting on your WhatsApp or on your Instagram stories. You guys know best, but once we get to 800 likes, I will definitely drop that video because I'll know that all of you are still on track. All right. Today's video has this pathway. Firstly, I'm going to define stock or share. Secondly, we're going to touch on managed funds versus self-managed funds. Number 3, we're going to differentiate between individual stocks, ETFs, and ETNs. Number 4, we're going to talk about local versus international shares. Number 5, I'm going to touch on the tax-free savings account. Number 6, I'll quickly highlight the type of documents that you'll need as an investor. And lastly, number 7, my favorite, I'm going to be showing you how to choose a company as well as how to read the graphs so you know when it's the right time to buy and the right time to sell. Let's do a quick knowledge test. I would love it if you guys could actually go to the comment section and let me know what you think the best investment is. We've got investor A. This person has a portfolio value of 3,581 and they've earned a percentage of 16% return. And then we've got investor B, who's got a portfolio value of 201,575 with a percentage return of 4%. So let me know in the comments which one you think is the better investor. Is it investor A or investor B? I'll provide you guys with the solution as well as a reason to how I got to my answer later on in the video, so make sure you stick around and do not change your answers. Tell me what your response is firsthand, then let me teach you what I know, and then let's see if your response stays the same or if you change. Alright, cool. So the words are quite interchangeable. Some people will say let's buy stock, others will say let's buy shares, others will say let's buy equity. However, it all means pretty much the same thing. Investopedia says a stock, also known as equity, is a security that represents the ownership of a fraction of the issuing corporation. Units of stock are called shares, which entitles the owner to a proportion of the corporate's assets and profits equal to how much stock they own. Sounds pretty complicated, but basically if you and I buy shares in a company, or a fraction of the shares, because nowadays we can actually do that, it means we own a portion of the company. So when you think of a business, usually you think of one big owner who owns the entire thing. That's usually your sole proprietor. Basically, like if you and I were to open something, you are the only owner of your business. However, when you look at big corporations and big companies like your ShopRite, your Naspers, your Glencore Mines and all of that, those type of companies are publicly listed. This means that there are multiple people who own portions of those shares, and therefore you and I can actually be one of those owners. So basically, if you own shares, you are a shareholder. In the past, you used to actually buy shares by calling or going to the stock exchange and actually writing a physical document and saying that you are buying XYZ for this amount. However, nowadays we have brokerage apps which make this much easier. Basically, we can buy shares of multiple companies by a couple of clicks on our cell phone. Just a reminder, you and I can only buy shares that are publicly listed on these brokerage apps. Basically, they are registered on the stock exchange. It could be the Johannesburg one, New York, London, and so on. However, you might also be able to buy shares in privately owned companies if you know someone or you've been invited to be an investor. These are very rare, so I will not be touching on these. However, for the publicly listed companies, I will be showing you step by step how to actually go about buying shares in your favorite companies. When it comes to investments, you can have an investment firm managing it, or you can self-manage. If an investment firm is managing it, you most likely will have a fund manager, and this is for companies like your Allen Greys, your Coronations, PSG Wealth, and so on. However, if it is self-managed, you will probably have an app on your cell phone. For the investments with fund managers, this simply means that you don't have to think about how your money is allocated, because a professional has been hired and they will try and find the best picks to grow your money. However, regardless of how they perform, you will still pay a fee for them, because at the end of the day, they have done the work. Most beginner investors will probably fall under the self-managed umbrella. This is because it is easier to enter. You can invest as little as 10 Rand, and you also have full control of your investments. Basically, you can chop and choose however you wish. Let's have a look at individual shares versus ETFs and ETNs. When it comes to buying shares, you have a choice. You can either buy a specific company. So if there's a company you have in mind and you really want to buy shares, you can go and find it, or you can buy a basket of shares. For specific companies, a lot of you might be thinking of your Mr. Price, Sasol, ShopRite, Glencore, Naspers, or if you're looking at the international markets, it's things like Apple, Amazon, Tesla. However, the truth is not a lot of us have time to be researching and thinking about which companies are performing well, which companies are going to bring me the best return. So usually the best bet for someone like you and me who does want to invest but doesn't want to spend their entire day going through the markets, looking at financial statements and trying to understand some of the terms used, it is then recommended that people look at ETFs. An ETF, by definition, is an exchange-traded fund. It is a type of pooled investment security that holds multiple underlying assets rather than only one. So in basic terms, it is a pool of shares. If someone goes to buy an ETF, they will only click buy once. However, that ETF will give them exposure to multiple companies all at once. This is because you will be investing in different companies at the same time. For example, in the US, there is the S&P 500. This is an ETF which invests in the top 500 companies in the United States of America. And however much you invest, it will be broken down proportionally to the weightings of these companies. There's also the S&P Europe 350, which are the top 350 companies in Europe. In South Africa, we have the Satrix Top 40. So these are the top 40 companies in South Africa, and likewise your investment will be split across like that. So buying an ETF gives you exposure to companies you might not have thought of, however would have probably invested in if you knew about them. Top investors do encourage beginner investors to look into ETFs because they usually say this is a safer investment because it is unlikely that all 500 or all 40 companies perform badly.
In my view, for most people, the best thing to do is to own the S&P 500 index fund.
Therefore, if one company does badly, the other ones will probably still uphold your share, versus if you do an individual share, you never know how things will turn out. It could be a really great investment or maybe a poor choice. Lastly, we have the ETN. These are exchange traded notes, and these are unsecured debt securities that track an underlying index of securities. In simpler words, these are unsecured debt, so there are no underlying shares. Basically, you're not buying into any companies, and also you are issuing a loan to these companies. So you are hoping that they pay you back. However, there is usually more risk when it comes to ETNs, which is why most apps will make you do a quiz just to understand your risk appetite. However, I don't really have much personal experience with these, so I can't talk much on them. When it comes to investing, a lot of us are not sure whether we should invest in the local markets or in the international. The truth is, you should do both. This is because of something called diversification. Diversification means owning a wide variety of investments with different characteristics to reduce volatility. Basically, it means don't put your eggs all in one basket. Try to spread your money across different types of investments so that if one doesn't do well, the other can still recover.
So because I like to equip you guys and show you how you can also do these things for yourself, I'm going to use AI, and I've asked it to explain diversification as if I was 5 years old. And this is what AI had to say. Okay, imagine you have a big box of different kinds of toys, some cars, some dolls, some blocks, and maybe even some puzzles. Now, if you only had one type of toy and something happened to it, like it broke, you wouldn't have anything else to play with. But if you have lots of different toys, even if one breaks or gets lost, you still have plenty of other toys to play with. So diversification is like having a big box of different toys. Instead of putting all your eggs in one basket or all your toys in one box, you spread them out so if something goes wrong with one, you're not left with nothing. It's a way of keeping your toys or your money safe and having fun with different things.
Another story that I've heard, which I have not fact checked, is that apparently there were 4 people who knew the Coca-Cola secret recipe.
I googled it, apparently it was only 2, but let's continue.
And those 4 people were never allowed to fly in the same plane. This is because Coca-Cola did not want to risk having their entire 4 founders dying with the secret recipe. Therefore, whenever the founders had to travel, they would use different planes, different airlines to try and mitigate the risk. So basically, do not put all your money in one place, because if something happens, you need to be safe and have another basket waiting for you. When it comes to investing, it is good to have both local and foreign investments. This is because if anything happens in your country and the entire economy is suddenly devalued, you will still be safe because you also have other investments in other countries. Now, there is a chance that the entire world goes through a big crisis, as we recently saw with the pandemic. However, if the entire world is panicking, I think investments will be the least of your worries. So continue to invest both locally and in foreign markets. Before I forget, the government will try and encourage you to invest locally just because you are helping our own economy. So when it comes to your tax affairs, you will find that you probably have bigger tax breaks for your local investments versus your international investments. However, we'll cover this in the tax scenario, so don't stress about it. If you want to invest, you should. When it comes to tax-free savings accounts, these are investments that the government have set up to encourage people to invest. Basically, you can still invest in stocks and shares. However, any gains, dividends, or income that you make from these profits will be tax-free. This is because the government is trying to encourage people to actually invest, because if people are financially savvy and investing, it means the government will have less people to worry about in their old age. So make sure you put good use to those tax-free savings accounts once you understand them. However, if you're still unsure what they are about, I would suggest that you hold off of them because there are certain limits. Basically, everyone can only contribute a maximum of 36,000 Rand per year and a maximum of 500,000 per lifetime. This is because anyone who's able to contribute more than this probably does not need the tax breaks. However, please do be careful, because this is the type of account where you don't want to be putting in money just to withdraw it later, because your limits will not be refreshed. Basically, if you put in 36,000 this year, then you took out 6,000, you cannot put in another 6,000 Rand, otherwise you will be taxed on that additional 6,000. Once you've reached your limit, regardless of how much you withdraw, it still counts as a contribution for the rest of your life. If you do have a child that you'd like to open a tax-free savings account for, you are able to do so. However, please do remember that the limits will apply to them for their entire life. So if you have maxed out their 500,000, which is great, congratulations to your kids, they will not be able to add more without being taxed. P.S. Some of you may already be contributing to your tax-free savings account through other products like money market products or the Stash app. Just remember that the limits apply to all of your funds. So you can't put 36,000 on one platform and 36,000 in another and think that they won't pick it up. You are using the same ID number, so it will be flagged and you will be taxed. Cool. The documents required for these apps might vary slightly. However, most of them will require your ID number. They might also ask you to upload your ID as a document, so just have it as PDF on your phone. They might also ask you for your tax number. However, if you're a student or you've never worked before and you don't have a tax number, just deselect this and say you do not have one. And in the rare occasion, they may ask you for proof of residence. Usually you can submit your bank statement. And the only reason these apps need this is because of regulatory rules. So the Reserve Bank and the government always want to know who's investing what. And if you're not South African, you're still able to invest in most of these apps. However, you might not be able to buy any South African stock, and especially not the tax-free savings portion, because this is only for citizens. So even though experts will recommend that we invest in ETFs or baskets of shares, I know a lot of you still probably want to pick your own shares because it's nice to know what you've invested in, or someone somewhere told you that this is a really good buy. So let's have a look at actually choosing these companies and understanding the graphs. What I always say is, if you're going to invest in a company, invest in a company that you understand how they make money, understand what their process is. Obviously, you don't have to understand the full intricacies or the full details, but basically know what is it they sell, why is it important to the economy, why do I want to invest in it. 2, invest in companies that you use or potentially will use in the future. This is because I enjoy buying things at a shop where I'm like, I'm a shareholder. So when I splurge on certain things, I justify it by saying, ugh, I'm paying myself indirectly. And number 3, invest in companies whose ethics and morals you agree with. Obviously, this is a personal list and you're free to do whatever you want. However, I do want to say, guys, please be very careful about some of these tips or hints that you get about which stock is going to be super great and you need to go invest so that you milk it. Because sometimes you get people who are investing influencers and they will pump a certain stock, build a lot of hype, and this happens a lot in America. However, I have also seen cases where it's been happening in South Africa, and these investment influencers will have money in those companies and they'll tell you guys to go put money in a certain stock, and then it will inflate the share price because suddenly there's such a huge demand, everyone wants to buy it, and then these people will pull out their investments at a profit, and then the share price will tank, and then you guys will be left with the mess. So please do avoid listening to some of these things. Obviously, I'm not perfect. I've also taken hints off of Twitter and sometimes Facebook, and you know, I've like bought certain shares. It's good to experiment, so ride the hype, see how it works. It might really turn out well. However, it might not go so greatly. So just be very careful. This is your hard-earned money and you don't want to lose it just because you just want to listen to whatever people are saying and you're not really thinking about it or processing it or looking at the graphs. You're just going to take their word for it. Often you hear people say you must buy low and sell high. This basically means you must buy when the share price is low, and then wait until the company has great results, because then their share price will increase and then you can cash out at a profit. Other people don't cash out, they'll just hold on for a long time, and I usually tend to be this type of investor. I'm more of a passive investor. I put in money and I'll kind of see it 6 months later. However, I'll probably only take out money at a much later stage. As we get into this investing series, you will see a lot of people will say, I want to make a good return, or I want to make a 10% return. And basically a return is the change in price of an asset, investment, or project over time, which may be represented in terms of price change or percentage change. A positive return represents a profit, while a negative return marks a loss. In simple terms, this is how much you gained or lost from your investment. Some people will quote prices, however, most of us will use percentages. This is because it's easily comparable, because if I tell you I made a 10 Rand profit, it's a bit confusing because you don't know how much I put in. Maybe I only put in 5 Rand, so 10 Rand profit is good. Or maybe I put in 5,000 Rand and a 10 Rand profit is like, so. So a lot of us will use percentages because it is easier to relate. And now it's time to have a look at what you said earlier on. The correct answer, or rather, the better investor, was investor A. This is because investor A had a return or a profit of 16%. This means they only put in 3,087 Rand, however they made a profit of 494 Rand, which is represented as 16%. Investor B, although with the bigger portfolio value of 201,575, they actually put in 193 Rand 823 and only made a profit of 7,752. This is a 4% return. To compare like with like, if investor A was given the same amount of money that investor B had, so the 193,823, investor A would have had a total portfolio value of 224,834. Basically, investor A knows how to make their money make more money, whereas investor B probably would have made more money had they kept this money in a bank or invested it in something safer. So let me know in the comments. Actually go and reply to your own comments and tell me if you got it right or wrong. And let me know if you understand why investor A was the better investor or not. And now lastly, I'm going to be looking at a share price of a company. I'm not going to tell you which company it is because it doesn't really matter for this example. But what I want to show you is when it is a good time to enter versus a bad time to enter. So for this company, I've just actually typed this on Google. We can see that their share price is currently at 14,178 Rand and their graph is green. The reason it is green is because at opening, at 9 a.m. they opened at 14,080 Rand. However, now at closing, at 3 minutes past 5, they closed at 14,178, which is higher than the 14,080. If for some reason they had closed at 1, where the share price was 13,625, this graph would actually have been red. This is because they would have closed at a lower price than what they opened at. But don't stress, this might be confusing, but let me show you some more. At the top of this graph, we can see that there is 1D, 5D, 1M, 6M, YTD, and more. 1D is 1 day, 5D is 5 days, 1M is 1 month, 6M is 6 months, and YTD is year to date. So basically from the beginning of 2024, which is the 2nd of Jan, because the 1st is a holiday, until today, this is what's happened. And if you click more, you can actually have a look at the 5 years, and you can also look at max. So when you're looking at investing, it's very good to look at all of these graphs, because if someone saw the 1D, they would have thought, oh wow, this company is doing super great, which means it's not a good time to go in because the stock is high. However, if you look at the 5-day one, you realize that actually they started the week on a higher amount than what they closed. So maybe it is a good time to go in. Then you look at 1 month, then you look at 6 months, and you realize that actually this company has been performing quite badly for the last 6 months, and their stock price went from being 24,436 Rand to 14,178. However, when we click on the max, you realize the graph goes back to green. So basically, when this entity began in 1996, their share price was only 4,530. In 2008, it reached a peak of 43,000, and then it dropped to 36,000. Then in 2014, it went to 62,000. Interesting. Then it dropped, then it went high. And then in 2020, it went through its worst. It was 5,760, which is almost close to what it began on, 4,530. However, if someone like you and me entered here, actually this was 2,714, this was worse. If someone entered at that 2,714, and actually some of you might be able to guess what company this is, because a lot of us went and bought these shares because they were so undervalued. And then they increased and we made profits. We were sitting in the 200, 300%. However, right now as it stands, this company has gone down again, and this is why you should not buy into hype. However, I would still buy into this company, because when you look at the graph over the entire lifespan, you can see that there is a general upward curve. Something clearly must have happened in the market recently, hence it's down, which means it's a good time for you to buy because it is underpriced, it is low, and we probably will see it going back up to 51,000 or 60,000 in the future. So buying in at 14,000 is probably a great time to enter, because when it reaches these peaks again, you will be making profit because your share price would have accumulated. So that is how you analyze a graph Do not just look at the one day. Do not only just look at 1 month. Have a look at all of these different types and understand what is happening. And if you want, you can even just do a quick Google search and be like, what's happening with X company? And maybe you'll be able to see why these peaks and troughs have happened to help you make a better decision.
Stocks are safe for the long run, and they're very unsafe for tomorrow. Berkshire, 3 times since I took over, has gone down roughly 50%. Did I feel poor then? No, not at all. I knew it was going to be worth more over time. American business is going to be worth more over time. That's what you're buying as a business. You're not buying a stock. You're buying a piece of a whole bunch of businesses. Are those businesses going to be worth more 10 or 20 or 30 years from now? Of course they are. But if you think you can jump in and out, or that you know the time to come in, I think you're making a mistake.
Alright guys, that's it for today. Thank you so much for tuning in. I hope you have enjoyed this video and I hope you've learned a lot. I am done with the theory. I am ready to get investing. I am ready to be spending some money and I can't wait to show you guys. So make sure you leave me a comment and let me know what you enjoyed about this video. And remember, I said if we hit 800 likes, I will drop the video early. So make sure you hit that like button and share it with a friend and tell them to like. And I hope you enjoyed this video as much as I have. And before I forget, because you guys are my loyal subscribers, comment down below and tell me which company you want us to go buy next week. I will actually choose 3 stocks that you guys recommend and I'll go through their specific graphs. The reason I'm asking you guys to suggest is because I don't want it to come from me. I want to be able to actually analyze things that you guys are typically interested in. So drop a comment down below and let me know which company you want to see. And if you're not subscribed, I'm sorry, I'm probably not going to choose your comment because you're not really subscribed. And if you haven't watched last week's video, now's probably a great time to catch up. However, let's move on with our investing series. There's so much I want to show you. There's so much to learn. Okay, bye.
If you enjoyed this video, please tip me with a like. And if you'd like to see future videos, please do make sure you've subscribed. But in the meantime, I have a couple of other videos that I think you'll enjoy. So head over to those and I'll see you next time. Bye.